Hello, welcome back. You may be wondering what is this company that you are looking at here. It's called Vertical Aerospace, a very small company. It's traded in the New York Stock Exchange, and it's a Great Britain company, as you'll see here. Now it has very few employees, 54. As you can understand, it's a very new company and a recent IPO. Yet I wanted to make this video for two reasons. First of all, the company is actually trending right now, so you'll find a lot of discussions looking around on stock tweets or Twitter. The company is discussed a lot, and it has moved quite some. And also, it's a recent IPO, and this is one of the key reasons why I want to examine it, because many people tend to think that buying a company at its IPO days is a good idea, regardless of what the company is doing financially, just because it's hot and it will get hotter, and at some point they will make more money and all that jazz. But what we need to understand is everything is dependent on what the company is doing financially, and this is why I wanted to show you this company, for which we practically have zero data, very few data here, very little data here. And we have to go by the financial statements. This is crucial. We don't have like 4 or 5 years of data here. We just have a few quarters, and this is why it really pays to, instead of just look at the metrics, like the key metrics, which won't tell us too many things because we don't have enough data. It's much better to actually directly take a look at what the company is doing in terms of revenues. And the first thing that you need to notice, regardless of that, and let me take you to the stock analysis chart here, is what the company is doing in terms of its market cap. Now they have a $1.7 billion market cap. So 1.7, that's quite a lot. That's a generous market cap, as you can understand. And you can expect a company to be making significant money, of course, in order for this market cap to make sense, right? I mean, you don't expect a $1.7 billion company to be making, I don't know, $10,000 a year, do you? That doesn't make a lot of sense. I mean, why would someone buy this company for that much? Because the market price of the company right now is $1.7 billion. And so typically you would expect a company to be making, I mean, it definitely depends on the industry, of course, but then you would expect them to be making about, let's just say, maybe you could say maybe 300 million, maybe something of that sort, if they are a company that's very steady. But they could make something even like 100 million, in which case you're putting them at about 20 in terms of a multiple, a little bit less. So generally speaking, you'd expect them to make at least 50 million, I'd say, is what would definitely make some sense here. 50 million is would be about a 35, I believe, PE over here, if they were making 50 million in earnings, if I'm calculating it correctly on the top of my head. But you can understand that you're expecting this company to be making significant revenue and net income, right? And free cash flow, of course. So now that you see that, let's take a look at the financial statements. And notice that the company in 2019 and 2020 made a measly $100,000 pretty much. And where does that put them? If you take $100,000 and use a calculator and multiply that to 20, what does that give you? It gives you a $2 million, right? So you give a multiple of the revenue, 20, you get $2 million actually, in terms of its expected market cap. And again, that's a revenue multiplied by revenue, not by income or not by net income or free cash flow, which is the typical thing to do. So you're looking at a company that's making very little amounts of revenue here, and it's traded for $2 billion almost. This is absolutely insane, and this is why trading these kinds of IPOs can be super dangerous here. And you will see here again that the net income is actually negative. And now even they're making just a few 100,000, they're losing millions here, as you'll see. Again, it's a very small company, and they can be doing, of course, much better in the future. Again, negative equity here. They could definitely be doing much better in the future, but this company is almost like the company that you can find next to you, like in a neighborhood. Like, this is a very small company, and it's actually losing money and losing free cash flow in the millions here every year. And so why does it trade that high? That's the question. And this is why I wanted to make this video, actually, and it's going to be a short one pretty much. You will see, yeah, this is a $1.7 billion company that's making $100,000 in revenue. So that's something to talk about. And actually, yeah, I wanted to take a look at the stock evaluation tool here. And of course, you cannot really project easily here, just because the net income margins are negative and super negative, as you can understand. But when we're talking about these companies that are very new, and they have a lot of potential growth, we can actually at least try to give them some some increasing revenue growth, because it can happen, and actually be much more lenient and be more aggressive with our estimates. So I'm gonna try that, for example's sake, I'm gonna use the 25, 35, and 50 insane revenue growth for the next 5 years, especially the 51. And net income margin, of course, I cannot be using negative, so I'm gonna be using a high one. Let's just say 20, 25, and 30. That's pretty high. And free cash flow margin, which I guess it's already kind of okay here. This is cute, of course, because of financials. But let's just say they're making 100, 110, and 120. So very, very lavish projections here. And an annual return of 13% is what I want to get. And when I hit calculate, you'll see that I'm basically getting zeros here, apart from this one, which is 1 cent. Because the company is not making money. I mean, compared to what it's trading, of course. The company is not making money compared to the current value of the company. Because remember, this has a lot to do with the market cap of the company, which is insanely high. And remember, if we took a look again, it was $1.7 billion, and the company is making 100,000 in revenue. And you will see here that it's still not trading as low as I think it could go, because the current valuation is absolutely insane. I just don't get it, and I just really wanted to make a video because you have to be careful about these kinds of companies. You'll see them trading at 9, 10, and then go down at 6 or 7 and be like, okay, I should buy here because they are low. But the thing is, what are you buying really? That's the question. And now you kind of know, because when you examine the metrics, you see that things are looking very, very dire here, and that's a very, very dangerous investment to make here. If that is even an investment, really, that's just a lottery ticket, which is probably destined to be losing in the future. I just don't see how this can keep doing well and make you money back. I mean, this is insanely overvalued here. I don't have words to say, really. Okay, so that's what I wanted to talk about in this video. A small little video about a small company, which is important to understand because it can give you some ideas about how to actually evaluate a company. And this is what this tool can really, really help you with. And this is why I wanted to make this video, because it can very, very quickly show you why this trending company is probably a bad investment to make right now. It could be good in the future, but right now you're massively overpaying to get into this one. So thank you for watching this one. I hope you enjoyed. If you did, take a look at this video that I recently made, and it's about Wynn. We're discussing Wynn, the well-known hotel and resort in Vegas. Again, thank you for watching, and I'll see you soon. Bye-bye.